I believe the US dollar likely loses 75% of its purchasing power over 10 years. That's my model. And I believe that the nominal price of gold, which is to say the US dollar quote for gold, not its value in goods and services, but the nominal quote in gold, likely mirrors the decline in the purchasing power of the US dollar. So internally, I'm believing over 10 years, the gold price is up in nominal terms, US dollar terms.
For most investors, gold and silver are still framed as trades, things you buy because you think the price will go up. But that framing completely misses the deeper reason these metals matter, especially at this point in the global monetary cycle. What Rick Rule and Lobo Tiggre are really dissecting in this conversation is not price action in isolation, but the long-term erosion of purchasing power, the structural consequences of policy choices, and how different monetary metals behave as that erosion accelerates. Recent price movements have pulled attention back to gold and silver, but the more important question is why capital keeps returning to them in the first place. Rick Rule approaches this problem from a savings and risk management perspective rather than a speculative one. His framework is built around real returns, negative real interest rates, and the quiet but persistent destruction of currency value over time. In that context, gold is not owned for excitement or upside. It is owned to preserve purchasing power when conventional savings vehicles fail to do so. Lobo Tiggre, by contrast, brings a disciplined contrarian lens to the same macro reality, focusing on cycles, volatility, and the way markets behave when narratives finally shift from indifference to enthusiasm. Together, their perspectives create a much more complete picture of where we may be in the metals cycle. Gold, historically, tends to lead when confidence in currencies begins to crack. Silver, far more volatile and structurally constrained on the supply side, often lags early and then accelerates later, sometimes uncomfortably so. That dynamic is starting to reassert itself, and it's forcing investors to confront a difficult truth. Late-cycle environments reward patience and preparation, not impulsive positioning. If you value insightful expert analysis and deep dives like this, please like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
As we speak, CNBC changed its previous Devil's Medal report on silver, which to have CNBC even cover silver at all was extraordinary last week, let alone a 10-minute video. Okay, they called it the Devil's Medal. This week, it's the Sleeping Beauty medal. And CNBC's talking triple-digit silver. So as a contrarian, I got to say, my contrarian wolf whiskers are twitching, you know. But more seriously, you know, even the most diehard silver bull will tell you that silver lags gold at first, and then more than catches up at the end. And I have been comforting myself by looking at the charts and looking at the numbers and saying it hasn't caught up yet. And if you look at the inflation-adjusted peaks, it still hasn't caught up. But I'm not sure that looking at the peaks is the right way to look at it. If you look at gains, well, where do gains come from? Not from peaks, they come from bottoms. If you look at the bottom in late 2015, silver has caught up to gold now. It has more than caught up to gold right now from that bottom on a percent gain basis. It hasn't soared way ahead, but it has more than caught up. And today, it's certainly rising faster than gold, something like 3 to 4x higher. It's a 1% up on gold, 3 or 4% higher on silver. If that suggests that we're in that catch up with gold phase at the end of the market, you know, you can't ignore the at the end of the market part of that whole thesis. I'm not saying this is the case. Put away your rotten tomatoes, dear silver bulls. But I'm just saying, A, be careful what you wish for, and B, don't ignore the data here. Like, you can be as bullish as you want, believe in triple-digit silver. Yes, I know that inflation adjusted, the peak is over $200. But, you know, silver is screaming north right now. And you yourselves have talked about what that means in the past. So you don't get to ignore that now that it's happening. And the big question is, you know, is this the blow off top or is this an adjustment? And Rick's former employers over there put out a report and they're saying it's due to the supply side. And there's real supply constraints going on. I don't have access to the math on this, but I know that copper mines produce more silver than even gold mines. The number one single source of silver is copper. There have been 4 major disruptions in the copper space in 2025. I don't know what that does to the silver supply, but it has to do something. So this is my bull thesis here. Like, there are legitimate reasons to think that silver screaming north right now is not the blow off top of this bull market. It has to do with silver supply. And if so, that's extremely bullish going forward for both monetary metals.
Would you be exercising caution at these prices, or do you think there's plenty of upside ahead?
Well, I'm on record 8 weeks ago as having been a seller. The truth is that the easiest money is the hate trade. You buy something that you believe there will be ongoing demand for over 5 or 10 years that is priced low, particularly relative to production cost, and we can talk about that in silver later. As Lobo said, primary silver mines generate between 18 and 20% of supply, so that thesis is tough there. But the truth is, the reversal of the hate trade is the easiest money for a speculator to make. Most so-called speculators, which is a different way of saying most losers, can't participate in the hate trade because they require the validation that comes from price movement to validate the narrative. And by the time that's occurred, the value of the narrative has been cut in half by price appreciation. The second thing is that most speculators, and I know this now from grading almost 100,000 portfolios in 35 years, most speculators that get the strategy right get the tactics wrong. They speculate in a print that will take 4 or 5 years to work, and they have trauma holding position over a long weekend. When the juxtaposition between your strategy and your tactic is that cattywampus, the probability that you make money is really close to nil, really, truly close to nil. People aren't going to want to hear that. You know, what people who listen to these channels want to hear is silver's going to the moon. They don't want to have to question the narrative themselves. They don't want to have to believe they're taking risks. They want to take the credit for their success, and they want to assign the blame to Lobo Tiggre and Rick Rule. Fine with me. I will continue to trade against their prejudice. The hate trade's out of silver. I need to say, personally, silver represents about 2% of my bullion holdings. I own bullion out of fear. I save in gold. I maintain liquidity in currencies. And that part of my savings, which are in bullion, are 98% gold. I speculate in silver stocks, which are even more volatile than silver. So, for me, in a sense, the question now that silver is no longer hated is an irrelevancy.
How are you currently viewing the silver mining sector? Obviously, a lot of these stocks have risen dramatically along with the silver price. Is there still opportunity there in your view?
Well, since I'm saying that I don't think we're in the blow off top phase, then almost by definition, that means there has to be some opportunity. Am I buying silver right now? Is it screaming north, or silver stocks? No. My last 2 purchases were uranium stocks that were down, not silver stocks that were up. That said, if I'm right that we're not in the blow off top phase, the supply issues do get sorted out at some point. Those other secondary supplies come back online, and then we get a bit of a, which I think would be healthier for the overall market, for the longevity. If you're in this for the debasement trade, why on earth should we have a blow off top right now? When, are the governments stopping to print money? Right? No, of course not. So a healthy breather and a correction, I think, would be an absolute gift for anybody that isn't long silver already. I'm long. Like, I can't lose on this. I'm long and I've taken profits. As Rick likes to say, sail beyond the point of no concern, right? So, it's challenging to try to put more risk on top of a risk-free position when you can't lose. But if you missed it, then that healthy correction and consolidation would be, a spectacular opportunity rather than, chasing things at all-time highs. So
Silver's role in a precious metals bull market has always been complicated by its volatility and its tendency to lag gold early in the cycle. As Lobo Tiggre explains, that lag is not a flaw, it's a feature. Historically, silver does not move in lockstep with gold from the beginning. Instead, it spends long periods frustrating investors before entering a catch-up phase where percentage gains can accelerate rapidly. When measured from cycle lows rather than inflation-adjusted peaks, silver's performance relative to gold becomes far more revealing, and recent moves suggest that silver is no longer asleep. What complicates the picture and makes this phase more dangerous is that silver's acceleration often coincides with heightened risk. Rising faster than gold does not automatically mean sustainability, but it also doesn't automatically signal a blow-off top. This is where disciplined analysis matters. The market is no longer ignoring silver, and attention itself introduces instability. However, what matters is survivability. If an investor understands why they own gold or silver, a drawdown becomes something to endure rather than escape. If they don't, even modest volatility becomes unbearable. Liquidity events, whether triggered by equity market stress, geopolitical shocks, or broader financial deleveraging, tend to impact all assets temporarily, including gold. But those same events often create the most attractive entry points for disciplined capital. Volatility, in this sense, becomes a test of preparation rather than a threat.
Let's say you listen to some, not us, but some other irrational exuberance, promoter in 2011, and you actually top ticked gold in September of 2011, just over 1,900 an ounce. Well, you've actually doubled your money since then. So if you listen to what Rick just said about having greater patience than a long weekend, like if you believed in the debasement trade, if you had confidence in why did I bother buying this shiny pet rock, right? And you weathered the storm, you came out actually ahead. And even not just the metal itself, but the stocks. If you bought the best of, you're actually substantially in the black. Like those best of, again, I don't need to name names. They're hitting all-time highs. So you've been made whole not only on the commodity itself, you've made money, substantial amount of money if you bought the commodity, even if you top ticked it last time, and you've made money on the stocks. So if Rick and I got careless and encouraged anybody to go out and buy the peak today, and that turns out to be the peak for this cycle before another big, Rick mentioned 30 to 50% drawdowns. The drawdown after that 2011 peak was almost 50% for gold. It's like, if that's the worst case scenario, that's what's ahead of us. As long as you understand why you bought it and you don't get shaken out, then the track record is that you will come out ahead eventually. Now, it might take years, right? I mean, 14 years to wait to come, to be made whole after 2011 is a long time. But the fact is that it happened. And I'm not saying that anybody has to wait 14 years for payday. I'm saying if the worst case scenario is that we've just peaked, like today, silver 63, 64 bucks, gold 42 and change, that's the top, like 2011 all over again. And we're looking at a 50% haircut. If that's the worst, that is actually survivable. Not only survivable, you can make money by A, holding on, and B, buying the dip. Like if you bought the peak in 2011 and had the absolute courage of your convictions to buy the low in 2015, you would be sitting on a lot of money, gains, not just made whole, but you would have made a lot of money by having the courage of your convictions there. So if that's the worst case scenario, I don't feel too alarmed by saying, yes, my base case is bullish. I do think gold goes higher. I don't have a price projection. I'm happy if I just get the direction right. So all of that having been said, similarly with silver, it's just, I don't know if it's like genetic or something. I just can't buy something at an all-time high. So I'm waiting for volatility. There's always some next scare or something, maybe some announcement from the current administration in the United States, that never produces any market volatility, right? Or, some AI trade scare or something puts a big scare in the market. There's a liquidity event. Like if the AI bubble pops, that really doesn't have anything to do with gold. But it's such a huge part of the market right now that going into reverse creates a liquidity event that puts everything on sale, even gold, as we saw in 2020 or 2008, or, Rick can talk about 1987. Sorry, I can't. So personally, what I'm doing is I'm long, so it's easy for me to say, but I am looking for dips in market. As Doug would say, Doug Casey, I'm waiting for volatility to be my friend in the space. But don't confuse that. That doesn't mean that I'm bearish. I'm ultimately bullish. And if I didn't own any today, I would buy. And if, like I started out saying, if the worst case scenario is I might have to be patient and have the conviction of my trade to make money on it.
I have been saving in gold and maintaining liquidity in primarily US dollars since the year 2000. I sort of reorganized my mind and my financial thinking in the millennium, and I decided to save in gold. And by the way, 2010, when the value, or 2011, the gold holdings in my portfolio fell precipitously. That coincided with the rest of my portfolio doing very well. So gold did its job for me. If you have saved in gold like I have, sadly, I still think in US dollars. I haven't, although I keep an alternative ledger in gold, psychologically, I still think in US dollars. But when I look at my savings in gold and I look at the price levels of various items against the value of my gold, I'm struck by how cheap housing is. I'm struck by how cheap gasoline is. I'm struck by how cheap healthcare is. When I look at the US dollar side of my ledger, I'm struck by how expensive all those things are. That's really an interesting circumstance. I think, I haven't done the calculation recently, but I think gold since the year 2000, and by the way, I didn't buy all my gold in 2000, I bought it consistently along the way. I think gold has generated a 9% internal rate of return compounded for 25 years, which is to say it's done its job. I've had a lot of interesting discussions with large gold holders recently as a consequence of going into the business of lending money against physical gold. And I was struck by a conversation that I had with a European family office in Switzerland about 3 weeks ago. I think they got it exactly right. They said they continue to buy gold in hopes that it goes down because gold for them is a store of wealth and insurance against other asset classes that they are already represented in. With regards to your earlier comment about gold price forecasting, I've decided over 50 years that price forecasters are headline seekers. I have never known anybody whose track record with regards to price forecasting had any measurable degree of success, ever, 50 years of watching that. With regards to gold, I have a very, very, very loose model. It is my belief that because of negative real interest rates, which is to say the yield on the US 10-year Treasury, relative to the rate of depreciation that I see in the US dollar, which is not the CPI, by the way, I think rates to savers are negative by about 380 or 400 basis points, which means that most savings products, long-term savings products in particular, are financial suicide. I believe, and I could be way, 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 way wrong, but I believe the US dollar likely loses 75% of its purchasing power over 10 years. That's my model. And I believe that the nominal price of gold, which is to say the US dollar quote for gold, not its value in goods and services, but the nominal quote in gold, likely mirrors the decline in the purchasing power of the US dollar. So internally, I'm believing over 10 years, the gold price is up in nominal terms, US dollar terms.
Rick Rule's framework ultimately returns us to a simple but uncomfortable truth. Gold should be measured against goods and services, not against the US dollar alone. When viewed through that lens, gold's performance over the past 2 decades has been remarkably consistent. Housing, energy, and healthcare appear expensive in dollar terms, but strikingly affordable when priced in gold. That is not speculation. It is evidence that gold has quietly done exactly what it is supposed to do. Silver's future, meanwhile, remains compelling but complex. Structural supply constraints, its monetary role, and its late-cycle behavior all support a bullish long-term case. At the same time, its volatility demands respect. Silver rewards patience and punishes emotional timing. It is not an asset to chase. It is one to understand, prepare for, and accumulate with discipline when opportunity presents itself. Taken together, Rick Rule and Lobo Tiggre offer a rare blend of realism and conviction. One emphasizes discipline, savings, and risk management. The other highlights cycles, contrarian thinking, and the importance of volatility. Their combined message is not about predicting prices. It's about surviving markets long enough to benefit from them. If you understand why you own gold and silver, volatility becomes manageable. If you don't, it becomes fatal. If you found this analysis valuable and want more serious macro-driven insights into gold, silver, and the global monetary system, make sure to subscribe. This channel is for investors who care less about hype and more about understanding how capital behaves when confidence in currencies begins to fade.